Welcome, everyone.
Thank you. Thank you very much, everyone, for attending. I know that one of the most precious resources is time, so we are very grateful for your time. My name is Richard Sussman. I work as a property manager, portfolio manager for Property Management People, and I'm also a member of the organizational committee for West Virginia's inaugural chapter of Community Association Institute. We are proud of all the work that's been done to get to this point, and we're very grateful for everyone who's contributed. So we're excited that, among other things, Community Associations Institute is to help empower, acknowledge, and give resources to the individuals who make community associations work and function effectively and efficiently. So, on that point, I'd like to introduce Crystal Wallace from Community Association Institute National to talk a little bit more about CAI and what it provides.
Awesome. Dean, oh, here comes the slideshow. Hi, everybody. Nice to see you. As Richard said, I'm Crystal Wallace with CAI, and just going to spend a couple minutes here talking about CAI for those of you who are new to CAI and maybe just some of you that need a refresher. So as we begin this program, I do want to add that we will be, if you have questions or comments, feel free to put them in the chat and we will share out relevant information after the program in the next couple of days. But to kick us off, I just want to tell you a little bit about CAI. We are here to advance community association governance and improve quality of life and be the global leader in advancing excellence in community association living. CAI is unique in that we bring together our homeowners, managers, management companies, as well as business partners. So we're representing the entire industry, which gives us a unique advantage in our market. We have over 50,000 members with 64, soon to be 65 once West Virginia gets the final approval from the board. So we're excited about that. Can move on to the next slide. So why does West Virginia need a chapter? As the organizing committee has shown me, they are a hole in the map if you look at the map of the US and does not have representation. And so, of course, has been getting support from neighboring states, but there's things unique to West Virginia that we need to address with education and networking opportunities and advocacy. So there's a growing number of associations in West Virginia with more than 1,000 associations, and we have a conditionally approved chapter. Doing this education is part of that, and we hope to officially move into getting our organizing documents, et cetera, in January. So we're hoping January, February to engage some of you on this call to be a part of planning additional programs and networking events and getting involved in advocacy. So those of you, we can go to the next slide. Those of you who are not members, of course, I encourage you to join. You're here today because you're seeing value in this education and this topic, and we hope to do more of that. So we do encourage you to join to take advantage of our resources, which includes award-winning publications, strong educational content, online documents, a members-only community to share information, and many more opportunities. For those of you who are on the call, are members of CAI, I encourage you to share this information with a neighbor or colleague or a business partner that you work with and encourage them to join as well. Okay, next up, the next opportunity that we have on our calendar is an advocacy day, which will be held in Charleston, and that will be on March 4th, 2026. If you're interested in participating, you may already received an email. You can email Tony Campisi, who's in our government and public affairs team. We'll also be sending out more information in January and February. So this is just so you can mark your calendar to be involved in that. I'm going to put a few links in the chat here in a couple of minutes, but I want to share some of the end of session reports for West Virginia so you can see what's been happening and about our legislative trends going forward. So I'll put those in the chat in just a couple of minutes. And then, oh, I'm sorry, can you go back one slide? Thank you so much. And then, of course, if you have any questions about getting involved with the chapter or membership, feel free to reach out to me. Again, we'll be sending out more information in January and February to engage more of you in this chapter. And I encourage you to just take advantage of all of the resources that we have available. Thank you so much for your time and for joining us today. And I hope you enjoy the educational program.
Thank you, Crystal. And as she mentioned, there's a ton of resources that CAI can provide. If you aren't already a member, we do encourage you. All the problems that you may be experiencing or the confusion of what do I do now that I'm on the board of directors? There are roadmaps, resources, others that have gone through what you've probably gone through, if not the identical issues. There are resources available to you. So what we want to do tonight is an overall touch on a few basic issues and do some questions. Please, again, reserve your questions into the chat. And if there's time at the end, of course, we can do a round robin for appropriate questions. As a reminder, the speakers are going to be providing general advice or best management practices. If you have a specific question to your association or specific facts, we encourage you to contact a professional of the appropriate type in your area. For example, some of our speakers might be able to help you. But we're generally going to cover the legal foundations and troubleshooting for associations. We're going to touch on risk management and insurance, both for homeowners associations and homeowners. And the final category are reserve studies to help make sure that the associations are financially sound. So for the next slide, I would like to introduce our speakers for the legal. We have Mark Redette and John Bashara, and they would like to educate us in general and then handle a few questions. Again, please keep them general, and we look forward and thank you very much.
Good evening, everybody. My name is John Bashara, and I'm an attorney out of Charleston, West Virginia. My firm has a lot of experience working in this space. I myself concentrate a large part of my practice in common interest communities and homeowners associations in West Virginia. I want to give you a little bit of a brief history about common interest communities in West Virginia because it leads into the Model Act that we ended up adopting in 1986. Up until 1980 in this state, there was no comprehensive act for all common interest communities. There was only something called the Unit Property Act, which covered condominiums. There was no structured regime for planned community subdivisions, those types of communities. In 1980, West Virginia adopted the Uniform Condominium Act, which was a model act that has many of the same parallels that the current legislation, Uniform Common Interest Ownership Act, has. Then in 1986, the West Virginia legislature decided to adopt the Uniform Common Interest Ownership Act, which covered three types of common interest communities in West Virginia. Those are condominiums, planned communities, and cooperatives. But first, the idea, the definition of a common interest community was defined. So, Chapter 36B of the West Virginia Code enshrines UCIOA. It defines a common interest community as real estate with respect to which a person, by virtue of ownership in a unit, is obligated to pay for real estate taxes, insurance premiums, maintenance and improvements of other property. What does that mean? It means by virtue of owning a unit, a lot, a piece of property, you have to pay for the maintenance and upkeep of other property. So many of you, I'm assuming, live in a condominium or a subdivision. When you buy in, buying in obligates you to help pay for the common areas of that community, which are the roads, or in a building, the elevators, the hallways, all those types of areas. And this is
Sorry, John, I apologize for interrupting. Daniel, can we forward 2 slides, please? Oh, there we go. Thank you. Back one.
Go back one. Sorry. The purchase of that unit obligates you to pay for the maintenance and upkeep of the common interest community. Common interest communities are created by the filing of what's defined as a declaration. These are your covenants, your restrictions. This is the constitution of your community. It says what you can, what you can't do, how you can build. ways improvements may be made, the establishment of a homeowners association. This is the master document for your community. The unit is the physical piece of property that you own. That's your lot number, your unit, the piece of property you are taking title to in fee. And as I explained earlier, the common elements are the areas of the common interest community that are owned by all of the unit owners within that community. So to sum it up, West Virginia in 1986 established a statutory regime to create common interest communities. Under that act, you create a common interest community by filing a declaration with the county clerk's office. That declaration will define what the units are, what your common elements are, the rights, duties, and obligations of all of the members within that community. And one important thing to note that is often not noted and often lost on people is Chapter 36B is a mandatory act, meaning if a developer is creating a common interest community in this state, they don't have the ability to opt out or say this act does not apply. Now, I'm going to qualify that by saying there are certain exemptions that certain communities can qualify for that drastically limits the applicability of the act, or in some instances, such as purely industrial parks, almost eliminates its applicability altogether. But I think that's an important thing for people to note is when you're creating one of these communities, the act automatically applies. That wasn't the case before 1986. You could almost do whatever you wanted. So on to the next slide, please. Thank you. So as I said, you create these communities by the recording of a declaration. Okay, that's your constitution. Along with that comes a plat or a map that shows the layout of the community. Again, there's a big difference between a plat for a condominium and one for a planned community. Again, they can vary, but they will show the common elements. They will show the units. They will show certain areas that may or may not have developer rights. All those things are going to be very specific to your community. After the declaration is filed, the homeowners association will be created after the first unit is sold. So the act actually requires that once the developer sells the first unit, you have to create the homeowners association. How do you do that? You file what are known as articles of incorporation. Now, in West Virginia, the law permits the homeowners association to take on a variety of forms. It can be a nonprofit corporation. It can be unincorporated. It can be an LLC. It can be a trust. I will say the majority of associations in West Virginia are either unincorporated or a nonprofit association because those offer the most effective constructs for membership, for exercising corporate authority, and all those other types of actions you'll need to take on the corporate level. Now, the articles create the association. The bylaws manage it. The bylaws tell you when will meetings be held, when a notice is going to be sent, how is the board of directors elected, how many members are there on the board of directors, all those types of things. And then along with the bylaws, you have resolutions, rules, architectural guidelines. So the board in West Virginia is empowered to adopt rules and policies that help govern the operation and management of the association. Now, it's important here, you'll notice that there's a hierarchy. So that hierarchy is important because at the very top, you have the act, you have the law, right? Below that, you have the declaration. Then below that, you have the articles of incorporation. Then below that, you have the bylaws. And then below that, you have the policies. So they control in priority from top to bottom. For example, a rule cannot conflict with or violate a bylaw, just like a bylaw cannot conflict with or violate a declaration, a provision of the declaration. So the rules are really used to help govern your common areas. I always give an example. If we have a pool in our community, what are the pool hours? When can you bring glass bottles there? How do you schedule a party for the pool? Those are the types of things you have with rules. A lot of associations also adopt rules for the collections of assessments, for fines, for enforcement. They really help the association better manage the common elements and the association itself. So then on to the next slide, and I'm going to let Mark Burdett take it off from here.
So I'm Mark Burdett. I'm a colleague of John Bashara's, and we work heavily in this area. And a lot of the issues usually stems from people not knowing exactly what their duties are. So let's talk about the duties of the association up first. So part of the association's duties is to manage, maintain, and replace all common elements. The whole goal is for property values to stay high and for everybody to enjoy where they live. So they need to enforce the rules of the declaration and the bylaws. Now, the board of directors are the mechanism to do so. So they're going to set enforcement procedures, fines, things of that nature, and create policies that are not contrary to the restrictions and covenants set forth in the declaration. Now, as I already touched on, the maintenance of the common areas is the big to do, and that's where a lot of people usually misstep. It's very important to ensure all maintenance is taken care of. If maintenance is not taken care of throughout the years, then it could lead to certain legal issues. And I'm sure that our reserve study specialist is going to discuss that. And of course, assessments are always at the forefront, which are set forth in the declaration. At each annual meeting, a budget should be introduced that explains where the assessments are going, how the association is going to use those assessments to manage the common areas, how they'll pay the common expenses. And furthermore, assessments are usually a mechanism to ensure that all regulations are being followed.
And one thing I'll add to everything Mark just said, the Model Act, Chapter 36B, has affirmative obligations that require certain of these actions to be taken. And that's important because the law requires you to do it. It's not necessarily discretionary. The act actually says the board of directors shall act in all instances on behalf of the association. That's a big deal, right? So the board of directors has immense power and authority to take action on behalf of the association. There are limitations, but again, I'm speaking generally here. Just like assessments, the act says you shall assess based on this formula to operate, maintain, repair, and replace the common elements. The association shall maintain the common areas. So you have a lot of statutory obligations placed both on the board of directors and on the association itself to fulfill its duties to the owners within that community. Because really what's going on here, everybody that is a member of a common interest community is automatically a member of its association. Why? Because the law says so. But more to the point, for lack of a better term, you're all in this together, right? The board of directors manages and maintains this property for the benefit of everybody. They're unit owners themselves. I've often used a comparison that an association is a lot of ways like a trust. The board of directors are the trustees, and those trustees manage the assets of that association for the benefit of all the beneficiaries, who are the members, the unit owners. So I think it's important to note that you do have a lot of affirmative obligations under the Model Act itself.
And I'll add that part of the authorities of the board of directors is usually set forth in the declaration that they can create committees. I'm sure a lot of you have seen that, and whether it's architectural review committees or policy committees, as long as it's not running astray of the declaration, that is a power they have. Next, Daniel. All right, so for homeowners' duties, their roles, it's pretty straightforward. Just be an upstanding citizen of your community, pay your assessments on time, make sure you're not infringing on the restrictions of the governing documents. For example, if it says no short-term rentals, don't operate a short-term rental. Adhere to the policies that the board promulgates according to the declaration. And of course, participation is always something that wanes throughout the years. The longer a community is in existence, the less members tend to participate. But the more participation, the more visibility of what's actually going on in your community, it's very important to do so.
Yeah, and I'll add to that. the two primary responsibilities of owners in a common interest community are: one, elect the board of directors; two, approve the budget. Well, I'll say it's three, and then three, pay their assessments. So again, remember what I said earlier. The executive board or the board of directors acts in almost all instances on behalf of the association. So an owner is typically only going to really vote on a couple things every year. That's going to be electing their directors and approving the budget. Again, the Model Act says every year the owners, what actually says every year the board shall present a budget to the owners. And if less than half of the owners reject the budget, it will be approved. It's a very odd way to say it, but in effect, you get a majority vote of approval when you have a new budget. And that budget is going to set the assessments that each owner is going to be responsible to pay. And it is through those assessments that the association, one, funds the maintenance and upkeep of the common areas, and two, ensures the proper operation of the association. And I don't want to, I know we've got not much time, and we could talk about this for a long time, but assessments are the most powerful tool that the association has. It maintains the common elements. It funds the insurance policies the association has to have. It pays for certain improvements that members decide that they want to have. It also serves as a way to ensure the documents are enforced. Under West Virginia law, fines, penalties, charges are enforceable as assessments, which means if you violate the declaration and the association fines you, it can enforce that fine as an assessment, which means if you do not pay, it has a statutory 3-year lien that may be perfected. That's a big deal. I mean, that gives the board and the association a lot of power. And it makes sense, right? They're the ones charged with making sure the community operates properly under the law and pursuant to its declaration. So, as Mark said, participation varies from association to association, but those members that get involved typically do so because this is their community. They live here. Their kids play with the kids next door. There is an interest in seeing that the operations are done up to the standard of the declaration and up to the standard of the law. Next slide. Yeah.
So this one's pretty self-explanatory. Usually when boards come to us, it's because they're not exactly sure where their authority lies. What does this provision mean? What does that provision mean? So just as Richard has on here, when a common interest community exceeds its authority. So again, it's when the board usually oversteps. So they take what is a common restriction and they make a policy and expand upon it. That's typically when boards get in trouble or associations get in trouble, or they are increasing assessments incorrectly. We see a lot of voting procedures not being followed exactly the correct way, and that's another way.
And one, to dovetail a little bit more off, I'm not sure how we are on time, Richard, but
You're good.
in exceeding authority is the obvious one. But what often will happen in these communities is a lot of these have been around for 50, 60 years and things have been done a certain way. And it's important for new board members to well acquaint themselves with the governing documents, with the community, because just because something's been done a certain way for so many years doesn't mean that it's right. Mark and I have been involved in a lot of matters where new members come onto the board and they start looking at things and say, well, wait a second. I know it's been done this way for 40 years, but maybe this isn't right. So I always encourage new members of a board to acquaint themselves with the governing documents. If they have counsel, have an orientation. I'll tell you, I have clients that they have an orientation policy. Remember, I was mentioning policies earlier. They have an orientation policy that says when you're added to the board, we're going to sit down, we're going to go through the governing documents, we're going to explain to you the law and how this works. It makes for a well-run, effective association. Because I can tell you guys from experience, an association that is efficient and effective, has members that care, directors that are invested, is going to better serve their community beyond an association that doesn't really enforce the documents, doesn't do what they're supposed to. That's where you wind up into trouble. There's the old, it's like a cliche about the homeowners association bothering the owners. Well, I can tell you something. The association that is actually enforcing the documents and actually doing its job is the association that I would want to live in. Because again, they're protecting your values. They're ensuring that the community meets the requirements of the law. And again, it's a great thing to see when these associations truly operate up to their standard.
Okay, we have a couple of questions, and both of them, interestingly, have the same topic, focusing on the applicability and the exemptions. So the small, the pre-existing, and then, of course, the limited expense liability communities. So
Sure.
you can briefly touch on that.
So the Act accounts for pre-existing communities. So if you were created before 1986, only certain provisions of the Act apply to you. One of the most important of those is Article 3, Section 116, which is the lien for assessments. You might recall earlier I was talking about how not only are your annual assessments enforceable as a lien, but how fines are as well. So that section applies to pre-existing communities, which gives a 3-year statutory lien to associations. In fact, it actually gives a super priority, which means you have, for 6 months, you can even jump a deed of trust. I don't want to go down that rabbit hole. I know I've got to get moving. What were the other ones they asked about? If your community is restricted solely to commercial and industrial use, the Act does not apply. If you are a limited expense community, now this is one that is found all over the state and that we've dealt with a lot. That exemption says if your annual assessments are less than $300 as adjusted based on the CPI formula. I think today the adjusted number is like 1,300. It's like somewhere in the mid-$1,000. If it's less than that number, then you can be exempted from the majority of the provisions of the Act. But to capture that, it must be expressly stated in your documents, and there can be no way to circumvent it. So for instance, if it says our assessment shall not be more than insert formula, and then later on it says by majority vote of the directors, you can raise assessments to whatever number, the exemption's blown. So again, those are 3. Was there another one? I'm trying to find the question.
The original question was, does the Act apply to everyone? And just to apologize, just to clarify, and double check me, John and Mark, the Act absolutely applies to everyone, pre-existing or otherwise.
Correct.
But the question is, for your specific documents and the language that's in them, all or a portion of the Act may only apply.
Correct. The way to say it is the Act applies to everybody, but all or a portion. That's correct. It applies to all common interest communities in West Virginia. The question is, to what degree? Can I briefly touch on the limitations on assessment increases? So again, guys, all of this is qualified by what your documents say. A lot of this is going to vary from association to community. And I don't know if we put the disclaimer at the beginning, but this is not legal advice. I'm only presenting. Do not take any of this to the bank. I don't represent any of you. The annual assessment is used to pay for the common expenses of the community. What is a common expense? The common expense is the financial liabilities of the association. Okay. In most associations, it's the upkeep of the common areas. In a planned community, it's often the roads, right? That's the big one. Condominiums get a lot more complex because you've got elevators, hallways. You might have common areas. If it's a big commercial condominium building, it's sort of a ski resort, you might have a restaurant. So your assessments are used to maintain those common elements, and they are made pursuant to a budget. So if, say, in a community, they have a budget, but then there's an extraordinary event, a casualty event, the roof blows off, and you've got to maintain and repair the roof, but you don't have enough money. What do? You assess. It is the job of the board of directors and the association to operate, maintain, repair, and replace the common elements. This became a really big debate in this country after Surfside in Florida. Because if you recall that case, there were, I believe, some steps to try to levy assessments to make the repairs. They voted them down. So now you've got this sort of catch-22. If your documents say you shall not assess more than X amount, but you have to have X amount in order to maintain the common elements, what do? Right? That's I can't point to you to chapter and verse that says what to do, but I think that the charge of the association is to operate, repair, maintain, and replace the common elements. If you're not going to do it, then terminate. So to Levi, to your question, again, it's very document specific, but if it is going to maintaining the common elements and fulfilling the obligations of the association, it's generally okay. Now, a lot of associations will have, to increase it by more than 20%, 51% of the members have to approve or something like that. That varies to degrees, right? You've just got to take that on a community by community basis.
Well, I would like to thank both John and Mark. Again, this was just an introductory to the legal foundations. We will do future education sessions focusing just on legal, so there'll be plenty of time. But again, if anyone has additional questions, general of nature, reach out and we'll do the best we can. If they're specific, contact an attorney of your choosing. Okay, and as John mentioned, Surfside and other issues that feed into it. It's a perfect segue, both for insurance and after insurance for reserves. So now we want to have Justin Arndt talk about insurance, both with the associations and just a little bit about homeowners.
Good afternoon, everybody. Or good evening, actually. A little bit about myself, who we are. I'm with RMP Insurance. My grandfather actually started this in 1976. We're coming up on 50 years. We're licensed in West Virginia, Virginia, Maryland, Pennsylvania. So we have a broad spectrum, kind of cross state lines, given where we are in the Eastern Panhandle. What we do a little bit of everything. I would like to say the one-stop shop, commercial insurance, home, auto, life, health, employee benefits. Gotta name it. We like to be able to say we can place it for you. But next slide, Richard. Insurance is something that most people don't want to talk about. It's not, they don't want it because the cost is associated cost for coverage, but what are you getting out of it? No one expects to have a loss and no one wants to pay a premium until they need it. And for insurance, I always say communicate, because when you're writing a policy, you see 5 different types here, but that doesn't mean each one is geared towards you as an HOA, as an individual. It's very selective. It depends on the nature of what you guys are doing, what your exposures are. Insurance is all about a transfer of risk. So you're taking one transfer, a financial loss, and transferring it over to an insurance company for associated premium. One of the main things, and probably the first thing you always start with in a commercial liability policy for an HOA, is general liability. Typically, not dependent upon the association. You'll see most times they'll go through a supplemental app. I pulled one up from one of our companies that lays out probably 20 to 40 questions. And why that is because, one, if you have a pool, you have any common areas that you guys, a pond, anything that you maintain, that's a liability risk. If you're just a HOA with houses, roads, your risk is a lot lower. Premium probably be lower as well. But when it comes to general liability insurance, the kind of definition protects against third-party claims for bodily injury, property damage, and personal advertising. Think about libel and slander. The main part of that, I always say third party. You always think about the other guy. It's not the HOA. It's someone outside suing. It could be a homeowner suing the HOA for negligence. When you think about bodily injury, say if you have a pool, someone goes on there, slips and falls. Did the HOA, are they negligent for that personal damage? That's where that general liability policy comes into play. Is the HOA in a common area responsible for trimming trees? Well, what if that tree is dying and a homeowner made you aware of it, and then that tree, a couple of months later, falls, collapses on their house, property damage. You neglected the duty and the maintenance of that tree is in your common area, and now it's caused property damage on a homeowner. That's a financial loss. Another for libel and slander, not very prevalent, but is a homeowner has something, the world we live in, Facebook, Twitter, all these social media platforms, say they go in there, say something inaccurate about a homeowner. The HOA is posting they didn't pay their dues or this or that, and that then comes back false, and then has a bad reputation for that person, and but more importantly, causes loss of income. That's a claim under your general liability policy. And one thing that most people forget, and this is probably some of the costly things when it comes to insurance, and why, in my opinion, insurance is the way it is today and the premiums are rising, is because they have a duty to defend you. Lawyers' fees are not cheap, whether it has merit or is meritless. They have a duty to defend you, and that's outside of your limits. You have $1 million policy. Those legal costs are outside that $1 million policy. They are obligated to pay up to your policy limits. Second one, directors and officers liability. And if anyone ever is on a board outside of being HOA, always ask, is there a director's officers liability policy? What it does, protects board members from personal financial loss due to a lawsuit alleging wrongful acts, errors, or mismanagement in their professional capacity. The main point on that is personal financial loss. So there's something that that board did, it's coming after you as an individual if there's no policy. Say you fail to enforce rules, those maintenance standards, which now are deplete or houses tearing down, worn down, and everyone else is nice, leads to declining property values. Someone maybe will try to sue the board of directors. Denying architectural changes, inaccurate or inconsistency on approving things, stepping outside of your bylaws, can come back on the directors and officers. Unauthorized changes. Board makes change to common area without member vote approval. It's a financial loss. We had a claim that a HOA was trying. The board was thinking about trying to buy a piece of property. That piece of property was a golf course. Well, it didn't happen, but a homeowner sued the board of directors because they're stepping out of line, and even though they didn't buy it and somewhat meritless, it was a over $50,000 fee just because legal fees were used to represent them. Financial mismanagement, misuse of funds, always a big one with the board of directors. You don't failure to set adequate reserves, and then neglecting maintenance. Say there's a broken sidewalk, someone trips on it. That goes back to your general liability policy of damages. But did you neglect it as a board? Did someone point it out to you, and then a month later you guys decided not to do anything about it? It didn't warrant any change. Fidelity protects the association funds from financial loss due to theft, fraud, or dishonest acts by individuals managing the money. Typically, in a homeowner HOA policy, you can find very small sublimits for what we call crime, employee theft, dishonesty. You always think about treasurer diverts HOA funds in their personal account. Always seems probably see most. Unfortunately, forged checks is another claim, and then funds transfer fraud is still in the realm of crime. You can always up these limits, and it goes back to it's based upon the overall risk of the HOA. How much reserves do you have? How much funds are in your accounts? And how many homes do you have? What is the financial risk that you guys have? The next one, workers' comp, covers medical costs and lost wages for workers who are injured or become ill while performing work for the HOA. This is if you have direct employees, it's not. You have to have it by the state. You're mandated, especially with W-2. If you're a 1099, you have 1099 employees that work for the HOA. directly for you. You provide the tools, you provide the hours. Um, you basically tell them when to show up, leave. That's the only job. That's kind of the only thing that they do. You are still liable to have workers' comp for that individual. Um, Independent contractors, they should have their own. So landscaper comes on, you hire them. Can't stress it enough. When they have a written contract in place, have that additional insured status, that waiver subrogation, the hold harmless agreement, and more so importantly, anything, obtain a certificate of insurance. That's how you're going to know. Don't just use word of mouth. Everyone, they don't typically, a subcontractor is not going to know if they have additional insured status. Not certificate insurance will prove it. Will show you that, and will help not get HOA pulled into a claim because of an injury or because of something negligent they did in a liability claim came from them. Volunteers are not typically covered unless endorsed on a policy. This is a tricky one. Given it's hard to place because an insurance company doesn't necessarily want to take on the risk of, well, how many volunteers there are. It's hard to essentially underwrite. Not to say you can't find it, but it's one of those things that it's a lot of gray and white area when it comes to volunteers. But if you have employees and you have volunteers as well, add that endorsement, little to no cost. Um, One thing to kind of point out that when it comes to workers' comp, there's one sort of lawsuit, third party overaction lawsuit. Groundskeeper comes on, gets hurt. They don't have workers' comp. Well, now they're trying to sue for damages back around to the HOA under their general liability policy. But how do you mitigate that risk? Get a sticker insurance, require workers' comp to help mitigate your exposure. The next one, umbrella. Not every HOA needs it. It's always dependent upon who would need it. Say if you have high reserves, how much money do you have in the bank account? What is your financial loss? What are your assets that if there's a claim, what can a lawyer come after? What can they find to indemnify the injured? You think about large associations, high exposures. Do you have pools? Do you have gyms, golf courses? Do you have like more of a gated community with a guard? Do you have high value properties? Those are all things that warrant a higher limit of insurance. Next slide, Richard.
Actually, before we move on, because insurance can be highly technical, and sorry for interrupting your flow, I just want to make sure there was a question about making sure dishonesty bond is the same thing as fidelity coverage.
Correct. You can do either or. So when it comes to me, typically a personal or a commercial package policy, or sometimes you can be put on a BOP, a business owner package policy. Those limits are already thrown in there. You see anywhere from like 25,000 for forgery checks and dishonesty, theft. Do you need more? You can always up it. It depends on you as an association, but typically don't need a bond. You can find limits within the commercial general liability policy that will suffice, I would say 9.9 out of 10 times to cover you. But you can find a bond. It's not uncommon. They're typically up 25,000 or so. I think I've seen, but another option. Correct. Yes. For homeowners policy, kind of going back to if you're on a board of directors, I highly recommend one having the kind of a higher limits in liability, personal liability. That typically starts about 500,000, and then depending upon the association, I would recommend an umbrella policy to protect you from that personal financial loss. If say your $1 million directors and liability or directors and officers policy kind of gets wiped out and they're trying to still recover at or recoup losses, highly recommend that. Another one, kind of, I think John touched on this, a loss assessments. There isn't within a personal policy, every homeowner's policy that you as an individual has a small portion for loss assessment. Typically not much. Think about anywhere from 1,000, 2,000, sometimes 10,000. You can always up it to even more. But that pays for any loss assessments that the community associations coming after. Say if there's a high deductible, not enough reserves, the limits exceed the policy, and then they assess kind of those losses to the homeowners. You have limits within your policy, but one, it has to be a covered loss within your homeowner's policy, a covered peril, we call it. And as well, your deductible will be applied. So, depending upon your deductible, depending upon how much you kind of get out of it. Next slide, Richard. When you get typically in trouble, it's simple. Exceed authority. You have your bylaws set. Are you overstepping? Like that claim I mentioned, they thought they had the capability to buy a golf course. Well, they were wrong. They're exceeding their authority, which then turns back financial loss to the HOA, and there's a lawsuit that presents it. And failed to follow advice from industry experts. You always have a question: is it covered? Ask. Don't go around. There's no problem with asking. If we don't know the answer, we'll find the answer. That's the thing. When it comes to those policies, it's like a buffet. You can have too much, you have too little, but we want you to have just the right amount. And that comes in trying to figure out what that is for you, and that talk to your insurance agent. Make sure you have what you need, and that the things that you guys are concerned about are covered. And then consequences for non-covered actions. One, you think about the loss assessment. You're trying to recoup losses coming after you as an individual, as a homeowner. Anytime, I don't think any homeowner wants to come out of pocket for expenses or damages. They're already paying an insurance premium. They want to make sure that that's covered. And then on my side, what will happen is it's hard to place. Say if you have a high claim, how high lawsuit out there, it's hard to find insurance. Increased premiums, it always gets brought back and gets put back on the consumer. So the more you have, the more follow the rules, keep everything maintained more so than anything. Have contracts in place that is going to protect you in the long run and make sure that you guys are set up for success. Richard, next slide, please. Avoiding claims, filing government documents is number one. If you have questions, Mark and John, ask the legal experts. What's in that? What do you have that you are capable? Don't overstep. Some of you think about finances and that fidelity question. Board review of finances. I was on a HOA in Georgia. We had an independent audit, things of that nature. So make sure that everything, all your eggs in one basket, everything's correct. There's not money getting taken out fraudulently. Everything's getting paid on time. A way to mitigate that: 2 signature requires on checks, not just your president and your treasurer. Make sure that you're avoiding kind of those just movement of money to the wrong places. And I know I keep bringing it up, but obtain a certificate of insurance for independent contractor. That's going to protect you more than anything when it comes to a liability claim getting brought back on something you don't have any say in. But because of their work, you have an interest in that common area. They can come back on you as a homeowner association. Well, if you do not have a contract in place, you do not have additional insured status, you don't have an indemnification clause, hold harmless agreement, all those things that protect you from getting pulled into a lawsuit because of, say, a subcontract that you hired to maintain your common area. Pool safety of a pool, clear rules. You have adequate lighting for the sidewalks, and then follow governing documents. And then when it comes to kind of claims management, report incidents immediately. don't try to wait. Don't, that hurts you. Never ever admit fault. Let the insurance company handle the legal aspect of it, fighting for you as insured. Um, don't admit that you were wrong. That puts you way behind the eight ball. And the insurance company does not want they without the back and forth. Take photos, document. You know, the more documentation you have, the better. But it's more than anything, just sit down with the insurance advisor, ask questions. Don't try to hide anything. We're here to help you in the long run. Um, we're always here to find kind of the best coverage at the best rate, I always say. But there's always an associated premium for what you're getting. Don't always chase the kind of cheapest. Make sure that you're adequately covered. And one thing I didn't mention before that you can always add is, do you have structures? I mean, tangible, do you have signs? Those are all things that, if something would collapse, do you guys have enough reserves to replace it? Or do you want to insure it? Is it $100,000 building that you want to insure? Because you don't want to, you're transferring a risk to the insurance company, a financial risk, to make sure that you guys are indemnified at the end of the day. Thank you, Richard.
Thank you very much, Justin. Do we have any other questions for insurance and general questions? If not, if you do and you can't think of something right now, just put it in the chat. We can come back to it at the end. So thank you again, Justin. Next, we want to hit our final topic, which is the reserve studies. So I'd like to introduce Levi Mason with Mason & Mason. And of course, he has a wealth of knowledge and experience. Go ahead, Levi.
Hi, my name is Levi Mason with Mason & Mason Capital Reserve Analysts. And first, I'd just like to say thank you for inviting me here tonight. Richard and I go way back, and I have always really appreciated being involved in anything that he is working in. And I also would like to say thank you to Crystal and Daniel. I really appreciate this opportunity. So Mason & Mason Capital Reserve Analysts has been in business since 1998. I personally have been doing reserve studies for about 17 years. And this is kind of a neat homecoming of sorts, because I lived in West Virginia for many years and graduated from Shepherd University, and very much enjoy any opportunity to have anything to do with where I regard as being home. So again, thank you for having me. So next slide, please. What is a reserve study? A reserve study, in a nutshell, is a way to have a common property association avoid having to make the phone call to John Bashara or Justin Art. We don't want you to get in trouble. Having an adequately funded reserve fund is the way to avoid getting in trouble. How do we do that? What we do is we come to your common property association, whether that's a condominium, a townhome, single-family homes. We have done churches. We have done schools. We physically go to the site. We inventory all of the common assets that could range anything from streets, parking bays, sidewalks, curbs, and gutters. As Justin said, golf courses. We've done golf courses. We've done swimming pools. The most insane thing I ever once inventoried was a 300-year-old pipe organ in an Episcopal church. That was very fun to price. You get the idea. HVAC. We physically assess and inventory all of these components. We generally know how long they last. We generally know how expensive they will be to replace. And we compile all of this inventory, and then we use financial tools and the financial health of the community to assess a budget for the community association to follow, so that each one of those individual components can be replaced or repaired at the end of its service life. We use all of this data, compiling it together to make a partial, to form the assessment so that those monies are set aside adequately over the period of the component's service life. What are the benefits of having a reserve study? The number one thing is stability. We are also protecting the investment and the property values of the homes within the community or the condominium. And we are setting aside the principle of generational equity. The term special assessment has been thrown out there repeatedly this evening. Liability. We are in the business of providing the stability so that there are no surprises. The principle of generational equity is critical in this regard because what we are doing is saying that people who are living in the community today are generally paying approximately the same amount of money when adjusted for inflation as people who are living in the community in 5, 10, 15, 20, 30 years from now. Why this is important is because a community has a fiduciary responsibility to protect those components so that they are generally well maintained throughout the service life of the community. What happens if you don't set aside reasonable sums of money going forward? As has been mentioned this evening, common properties tend to deteriorate. There is not enough money set aside to fix the components, and therefore property values suffer. Unsafe environments can occur. Children can fall off of deteriorated playgrounds and tot lots. Homeowners can slip and fall on sidewalks that are spalled or have tripping hazards. Or in the worst case, your condominium could collapse, like in Surfside. I don't think we need to worry about that in the panhandle of West Virginia, but you never know. Certainly, accidents are going to happen, and having an adequately funded reserve fund and subsequently well-maintained common property components is the best way to avoid those sorts of catastrophes. Next slide, please. So as I've mentioned, the point of the reserve study is to protect property values and to ensure that the community is well maintained. You are fulfilling the fiduciary responsibility so that there are no financial surprises. And as I've discussed, we are literally protecting people within the community from personal injury and all of the fallout, financial, physical, and otherwise, that could result from someone getting injured in a community. Next slide. Who performs reserve studies? Some architectural firms perform reserve studies, but you do not want an architect doing a reserve study. They're terrible accountants. Some engineering firms perform reserve studies, but you really don't want an engineering firm performing a reserve study either, because they could reasonably have conflicts of interest. What I mean by that is if you have an engineer come out and do a physical assessment of your property, they may identify things and recommend that engineering studies be done to remediate that situation. Some accounting firms also do reserve studies, but you don't want an accountant doing a reserve study. They're terrible engineers. Please, it's best to leave it to a reserve specialist. This is literally what we do. We are a hybrid between an engineer and an accountant. but we are neither engineers nor accountants. We are reserve specialists, and this is important. We look at common properties through a very particular lens that, frankly, not many other people do. Next slide, please. Principal ways to fund reserve assessments. There's the right way and there's the wrong way. Ideally, a community would be setting aside a reasonable sum of money each year, every year, spending money out of the account, performing the maintenance and replacement of common components. And each year, that sum of money would inflate by the rate of inflation generally. It would be the target. However, if adequate money has not been set aside through the period of over a period of time, and something happens, as has been mentioned, that's when the special assessment comes in. I have a client right now that has failed, frankly, to set aside adequate money for approximately 30 years now. They now need roofs, their balconies are failing, and their retaining walls are failing. I literally did the calculation during the meeting the other night. Each individual unit, there are 99 units, each individual unit is going to have to either come up with and or personally borrow $28,000. A lot of people simply can't afford that. These special assessments are absolutely devastating to unit owners within communities. People cannot afford that. Next slide. What is the legal basis for a reserve fund? These are established by the IRS as a tax-deductible expenditure for the replacement of association infrastructure. There are laws requiring various levels of reserve fund planning in many states and municipalities. And they are required by association bylaws and public offering statements. Next slide, please. Now, this is important. In West Virginia, there is no statutory requirement to conduct a reserve study and no statutory requirement to assess reserves. However, it is the right thing to do. And as John mentioned, it's all written within the bylaws. Next slide, please. So how do we go about getting a reserve study? The first thing you would do is go to a reserve study provider like Mason & Mason. I see Peter Miller from Miller & Dodson is on. Good to see you, Peter. We typically advise a minimum of 3 proposals to be issued. You ask for a proposal, the reserve study provider will issue one. The board reviews the proposals and selects the reserve provider. Upon selection, the project will be scheduled. The analyst will conduct the site evaluation and the inventory, and as well as a condition assessment based on visual evaluation. We gather the appropriate financial information, which would include the annual contributions and the current reserve fund balance. We compile all of the data, which we will talk about in the slides to come. We use proprietary software to develop Excel spreadsheets that help guide the process. And in so doing, we develop a funding solution that provides guidance for the HOA to follow throughout the course of the study period. For us, that's 20 years. Next slide, please. CAI recognizes 3 levels of reserve study. A level 1 is the first time a reserve study would have been done on a community by a particular reserve study provider. A level 1 basically goes through the process that I just described. We assess the condition, we do the inventory, and we develop a funding scenario. Ideally, between 3 and 5 years later, that community would seek our guidance again to update the reserve study. This would be a level 2. Generally speaking, unless there are new components added to the inventory, we accept all of our measurements from the previous reserve study. However, it's important to understand this. Level 2 updates are not necessarily less expensive than the original level 1 because just as much work goes into documenting all of the information that hopefully the community has gathered over the previous period between the first study and the second study. This would include the analysis of any executed contracts. We would look at the unit price. We would do comparisons on how these components are aging relative to what we anticipated. There's a lot that goes into a level 2 that doesn't necessarily go into a level 1, and so you should not experience sticker shock when you do a reserve study update and it costs approximately what the level 1 costs. And finally, the third level of update would be an administrative update. This is typically used in between the typical 3 to 5 year period. And what this essentially does is omit the condition assessment component of the reserve study. Typically, we would hold a meeting where we contact the board of supervisors, the property manager, and we have a conversation about what has been done to the community, what the real experience is, how much money has been spent, was there alignment on our anticipated contract price projections versus the executed contract price. Think of a level 2 administrative update as an interim course correction. All right, next slide, please. How are components scheduled for replacement? There are typically 2 ways. Number 1 would be normal replacement. This is where, in the case of a roof, outside of typical shingle replacements or things like that, roofs are not replaced in a cyclic way. In other words, when the roof achieves a full service life, it is leaking, it is no longer good, the roof is completely removed and replaced at 100%. That's normal replacement. The second mode would be cyclic replacement. The best example of this is a string of sidewalks or curbs and gutters that have heaved or deteriorated in other ways. You don't go in and replace all of the sidewalks at one time. You replace the sections that are bad. This is cyclic replacement. Next slide, please. After we do the assessment, we establish the price basis. We do the condition assessment, and this is our table 1. All of it, the reserve study providers that I'm aware of have some version of this table. You can see the asphalt component or the individual component listed. You can see its quantity. You can see the projected price. You can see what we call the asset base, which is simply the quantity times the price. And then you can see the schedule that we have established based on our visual or other information to assess when that component will achieve its service life. Then next to that, we provide some discussion about our observations, about the price. This is where we would talk about whether the component had been replaced or if there was a contractor scheduled to do the work, if we observed tripping hazards or other unsafe environmental issues. These would all be discussed in the discussion right there. We do this for each and every one of the components that we look at during the process. We use that data to develop the next slide. Oh, I'm sorry. Based on our findings and what we anticipate will be spent during that 20-year period, we develop what we call the fully funded goal. As far as I know, all reserve study providers use this nomenclature. What this means is you are on track. It doesn't mean you're rich. It doesn't mean you can stop contributing. It means you are on track. The example that I like to use is a car has 4 tires. The tires cost $100 and they wear out over a 4-year period. In order to be fully funded, you don't have to have your money, your $400 in year 1. You have to have $100 in year 1. You are then fully funded. By year 2, you would have $200. You maintain fully funded status. By year 3, you have $300. You get the idea. This is the basis for both generational equity, and it drives how we establish appropriate levels of contribution throughout the years. Next slide, please. So, how do we do this? There are multiple types of accounting methods. The first we are going to go over is the cash flow method. Next slide, please. And here we go. This is a typical accounting sheet. This is very simple to understand. It might not look that simple, but it is. You have your year, you have your financial liability, you have the amount of money in your checking account. You know how much money you are going to be putting into that checking account. We apply an interest income on that money. We then know how much you're going to spend out of that account, and that gives you your ending balance. We do this every year for 20 years. Now, the problem with this spreadsheet is it's not goal-oriented. It doesn't tell you anything about the health of the community other than whether or not you are going to run out of money. So, how do we get there? If actually you could go back one slide, please, Daniel. Thank you. How do we get there? All right. This is the second type of accounting sheet that you're likely to see in any one of the reserve study providers that you may hire. This is the component method. This is an extremely conservative chart here. If you could imagine, just take asphalt drive lanes and parking bays. We know how much they cost. Generally, we know how long they last. This accounting sheet simply sets aside X amount of dollars every year so that you can achieve that fully funded goal at the end of the service life of the component. It's really quite simple. Please stay on that slide. Thank you. What you do here is you go through each and every one of the line items, gets that allotted sum of money, and at the end of the day, you get down in the lower right-hand corner the fully funded goal. The question is, how do you get there? Because what you see by doing this component method approach is you get variable contributions each year. And it would be an absolute nightmare to fund a community like that. Boards would have to take a far more active role in the accounting, in the annual accounting and even monthly accounting, in order to achieve this goal. This would be a nightmare, but it is goal-driven. It is far-sighted. It looks all the way outside of the 20-year period, and that's really important because we're dealing with sometimes components that can last 50, 60, 70 years. Okay, not typically, but sometimes. But you can't fund reserves like this. So how do we do it? Next slide, please. What we do, and this is a bit proprietary, and I apologize for that, but what we have done is we take the fully funded balance goal as arrived at mathematically and conservatively from the component method, and we have married it with the simple accounting of the cash flow method. Next slide, please. This is the hybrid approach. This is the result. We plug in the fully funded balance goal. We then solve on the annual contribution in such a way that we have established a single linear contribution rate over time that inflates by whatever the rate of inflation happens to be at that time. The board can make the decision based on CPI and other factors. And you get this nice, smooth escalation over time, which brings us back to the principle of generational equity, right? Essentially, what you have here, this is an old sheet, but the people in 2015 are essentially paying the same amount in terms of inflation adjusted dollar as are the people in 2034. This is fundamentally equitable across generations. And this is really important, and it's really quite a beautiful thing. All right, next slide, please.
I believe that may be the last one.
Oh, okay, great.
Thank
So-
you very much, Levi.
Sure. Sorry, I started a little nervous there, but hopefully I was able to convey the ideas.
Indeed. Everyone should pay their fair share and to help not only the current, but the future generations to maintain that success of the community association. So, do we have any other questions? Well, if we don't, I wanted to thank everyone for attending. Again, your time is precious and we appreciate that. If you have other general questions, feel free to send them our way. Crystal has been very generous in posting a lot of resources and links in the chat. If you've been keeping up, you can save those links. And again, this education session will be available on the web portal. And Crystal, am I missing anything?
We will send you the recording as well as the links after this program, probably tomorrow or Monday. And I'm just putting a survey evaluation in the chat, and I encourage you to complete that as we're just starting out with our first program, and we want to get your input as to what you'd like to see in the future and your thoughts. So we would appreciate it.
Also, if you are a member already, please look at the online forums. We would like to post topics, invite additional members to the education committee, additional topics for future education sessions. Keep the comments and suggestions coming. Thank you, Daniel. Exchange, CAI-online.org.
Thank you. Have a good evening.
Any final comments, Richard?
Again, thank you for your time, and we look forward and we hope that you will join us on a journey to help educate, improve, and support community associations by joining Community Association Institute.
Thank you, everybody. Have a great evening.